You walk up to an ATM, punch in your PIN, and withdraw $200. Seems easy. But here's the thing, the $200 probably wasn't sitting in a vault with your name on it. In fact, your bank may have already lent it out, possibly multiple times, long before you tap that screen. So where does your money actually go the moment you deposit it? And more importantly, is it really as safe as it feels? When you deposit money into a bank, you're not placing it into a personal lockbox. You're lending it to the bank. Legally, that deposit becomes the bank's liability, meaning they owe that amount back to you whenever you request it. In exchange, they might pay you a small amount of interest. But while your balance appears stable on your screen, behind the scenes your money is actively being used. Banks lend deposits to other customers in the form of mortgages, car loans, business financing, credit cards, and lines of credit. They charge borrowers a higher interest rate than the rate they pay depositors. That difference, known as the interest spread, is one of the primary ways banks generate profit. At its core, banking is about managing that spread while controlling risk. Now here's where it becomes more interesting. Banks operate under what's called fractional reserve banking. This system allows them to keep only a fraction of total deposits as reserves, either as cash or as balances held at the central bank. The remainder can be loaned out. Imagine you deposit $1,000. The bank might keep $100 in reserve and lend out $900. That $900 may then be deposited into another bank, which keeps a fraction and lends out the rest, perhaps $810. That process repeats again and again. With each cycle, more money enters circulation. This is known as the money multiplier effect. It doesn't create physical cash out of thin air, but it expands the amount of credit and liquidity available in the economy. This mechanism is one of the reasons modern economies can grow, businesses gain access to capital, individuals finance homes and education, and governments fund infrastructure. Your deposit becomes part of a much larger financial engine. Of course, this system requires trust. If too many people demand their money at once, banks can face liquidity pressure. History has seen moments like this, known as bank runs. That's why modern banking is heavily regulated. Banks must meet capital requirements, maintain liquidity buffers, and undergo stress tests to ensure they can withstand economic shocks. Lending is not the only use of deposits. Banks also invest in relatively low-risk assets such as government bonds and treasury securities. They hold reserves at the central bank in the United States, that's the Federal Reserve, to stabilize the system and meet regulatory standards. At the same time, advanced AI systems now monitor transactions in real time, detect fraud, evaluate borrower risk, and optimize capital allocation with incredible precision. But here's the question that really matters: what happens if the bank itself collapses? If your money has been lent out, invested, and circulated through the system, what protects you when things go wrong? This is where deposit insurance comes in. In most developed countries, governments require banks to participate in deposit protection schemes. These systems ensure customer deposits up to a certain limit, meaning even if a bank fails, individual depositors are reimbursed within that threshold. So the next time you check your balance, remember, your money isn't sitting still. It's circulating through loans, investments, and financial markets. It's helping businesses expand, families buy homes, and economies function. Banking has evolved over centuries, and with AI and fintech accelerating change, the way your money moves is becoming even more sophisticated.